generally speaking, the stock market is now 15%.
I remember going back, I think it might have been last year, did a session on, talked about the last 20 years of the Australian stock market. And, you know, there's been this lazy approach from the public, and it's not, and Warren Buffett's been a big, facilitator of that, is buy the index, don't try and be a stock picker, and that theory has worked well. I remember going back 20 years ago, 25 years ago, where I was putting together portfolios, and it fascinated me that, people talked about just buying the all ordinaries. And I look back and I think that's where that diversification term I use quite a lot, that the four banks, Rio Tinto and BHP, held up the index. And I looked at that and I thought that's, so why have I got the balance of these companies? Why am I holding the other 194 or the ASX 300? Why am I holding those companies? That's a bit like a kid, on a swim team, you've got one outstanding superstar and he's holding up the whole team in a 4x100. And I know what that's like. So what we're seeing in the S&P now is that, and people have done, having said that, the S&P over the last, say, 2 years has averaged about 23, around about 29.6% per annum, which has been phenomenal. But what we're seeing is that a lot of these standout companies that have actually held up the S&P. So notwithstanding people have done well holding an ETF or the All Ordinaries, but going forward, I don't believe we're going to see, if you stayed in that and had that same mentality in the S&P, you could expect half that return. So half that return might be 14, 15%. That's not a bad rate of return. I personally have always been fascinated with the psychology of 15% of rate of return. People say, well, that's great. But I look closely at who are the ones that have done 30 and 40%, where are the ones that have done 12, and where are the companies that have done less than 15% loss? Because they get bundled together in this. So we are now in a stock picker's market. And a stock picker's market, let me tell you, is that requires the skill, not just to pick a share that's actually seems to be undervalued, it's understanding business. So you've got to think like a real business person. If you're going to buy that company, would you buy that company if you had the opportunity and go to the bank, know how to run it, and borrow the money to buy that corporation and act as the CEO? How well do you know this business? So, for example, it's a real defensive game rather than just buy the index. And I say that, for example, I was listening to a guy that I actually got to meet with the CEO of Netflix many years ago, and he told that wonderful story. And it came up on YouTube just the other day, and it reminded me, I was sitting up watching it, how he desperately needed a joint venture partner with Blockbuster, and it was a $50 million sale, and went to them, and Netflix decided to bring a streaming service in, a door-to-door service, and they laughed at them, and Netflix said, look, thanks, but no thanks. And the streaming, no one could understand that. Now you look back now, and Netflix now has just gone on and been a wonderful business. And so I look at companies now like I look at, if I had the money and the banks would give me the money, knowing what I know, how will that product evolve? So I need to understand the product. So Netflix to me was a no-brainer for me, and we've held Netflix for years. Apple we've held for years. IBM, we never really got involved with IBM because we never really, or Hewlett-Packard. Just never. So I think what I'm getting at is, if you understand buying businesses or just buying the index, you'll still do okay, but I'm looking at deploying where all of those companies are doing 20 and 25%. Why am I holding companies that are doing negative 15, negative? And it's obvious to me when you really study it about businesses that won't survive. We're looking at now at sectors. We think the accountancy market globally is a massive threat of how you see an accountancy business today will be obsolete in 5 to 7 years. Accountants will still be around, but doing tax returns, an accountant, it just won't be done. Law will change. So industries are changing. So I think that the S&P, you know, the key, it's a real stock pickers market. I've seen, personally, I've always held less securities and gone and it more heavily weighted. Now some people say, well, isn't that risky? If you analyse the last 60 years, if you're in a room with 500 baby boomers in Melbourne or Sydney, and you ask them the question that you've had one house, one location, one address, and you've been there and haven't diversified, borrowed a whole lot of money on it, non-deductible debt, and they paid 45 grand for it in 1972 and now it's worth 2.8 million and it's tax-free. Turns out those baby boomer investors didn't do too bad. They didn't diversify. And if you ask them, knowing what you know now, would you have done it again and bought another house? All of them put their hand up and they say, well, I would have done it if I had have known now, I would have run the gauntlet and bought two. That's what I'm saying about diversification, and I think that, you know, I tend not to diversify. I don't know anyone who's diversified an extremely diversified portfolio that has done extremely well. Buffett has done extremely well, predominantly in energy, predominantly in insurance and banking, and did well rode that wave on Apple and still rode that wave, but his foundation was, you know, really insurance and banking. That's where he made most of his money because he understood the business. You know, he owned the business and operated and they wrote their own paper. But he didn't diversify into, Berkshire Hathaway doesn't have 500 securities. If you call up today an industry fund, and I'll leave you with this, a balanced fund today is holding anything up to 730 companies. And that's why they're doing 10% rate of return, and they're too diversified. Now 5% are shooting the lights out. So getting back to the S&P is that for me it's about buying great businesses, understanding them. I don't want to have any of those companies that are losing 15, 20%. And it might mean, you know, my world, you know, even our global fund will hold no more than 25% of the securities, but they're the biggest, they'll be the most profitable and most innovative companies on the planet.